Okay, so again, today is our April 1st session. What we're going to spend most of our time on is Nike and the as-is valuation, then talking about Bull Bear and Target, as well as practicing again using Walmart as an example. So you did the Nike assignment, and I posted, let me go ahead and share my screen. I posted here on Elms, under the files section, there is week 4. There's a Nike folder and there's a Walmart folder. So the Nike folder has 2 Nike files. The first one, called Valuation Model Nike As Is Video, is the solution file that would be used for the homework assignment that you turned in this week. And this is what we did in the last class. And these are some screenshots of data that we're going to use. So if you want to play along at home with what I'm about to do, you can get a sense of that from these files. So in terms of Nike, this would have been your solution file that you turned in, getting into a share price within 4 cents of Nike. So just as a reminder, for this as-is valuation, what you had done in the third part of the class, the valuation, is using historical data of the company, which was provided from Bloomberg. We created a series of ratios that, if they came true, would create these forecasted income statements and balance sheets, which would create these forecasted cash flows that we turned into a share price valuation. And the goal was to come up with a share price valuation model that was very close, within $1 is the standard, but we got to 4 cents of the actual current share price of the company at the time. And that was called an as-is valuation, right? And the key to the as-is valuation is, the general principle is cash flows forecasted and discounted should lead to a price. So we're going to work backwards, which is, we know the price, and we know the formulas. So what cash flows lead to that price? And that's the idea of the as-is valuation. That's the first of the models we will do. Now, this is not your opinion. That's what will be shown up in the target valuation. And there's some scenarios we're doing, bull and bear, which we'll get into this class and next week. But basically, this is to justify the price at the time. So that's what you did. That's what you created. Before I go forward, questions about any of that or the assignment? And the solution file has now been posted. You can also check that.
I have a question.
Go ahead.
Oh, thank you.
Yeah. Why did we choose 3% for G?
Right now, we're using G as a placeholder that says it's kind of the growth of the long-term into perpetuity. And part of what we'll talk about today, because we're going to do a Nike valuation as of today in just a minute, is we kind of back into the growth, because there's basically 5 major variables that we're forecasting that drive value. Tax rate, we have a pretty good idea what the tax rate is going to be. Margin, EBITDA margin, we have a pretty good idea what the EBITDA margin is going to be.
I'm in the class.
The first 3 years of growth we know, and the WACC we know. So what we're really solving for, if the 5th variable is the growth in perpetuity, and to some degree the last 3 years, which don't matter too much. So we're kind of backing into the G that explains the share price, assuming that we know that we're comfortable that the other 4 variables are easier to forecast. So that's kind of what we did for this assignment. Next week, we'll actually talk more about, in the next week's class, the next week's videos, about how you actually get a more refined G. But for purposes today, we're backing into it.
Okay.
Other questions before we go forward? All right. So here's what I want to do in class today. I want to take this file, I'm going to save it as the as is for what's the April 2020, and this is the 845 section. And what I want to do is talk about how do we update this model to today, okay? So basically, I'll start out with some of the assumptions. So we need to check, do we still have a current year of 2019? Yes, right? Still operating cash? Yes. What is a current WAC for Nike? So if you had access to a Bloomberg terminal, which you do not, you would have gone to Bloomberg, typed in Nike, and you would have said WACC, and this would have given you a real-time WAC for Nike today. Right? You can see graphically over time, the WAC has been spiking up, more risk in the world today than there was at the time of this valuation. So today, the WAC is 10%. Now, I can take screenshots, screenshot save, and that is this file. That is this file, Nike WAC. Click on it, the 10.1% today. Okay, so what we're going to do is we're going to take our model and we're going to change this to 10.1%, current WAC for Nike. Now, the next thing we're going to change is the shares outstanding. Did the shares outstanding at the time of the valuation today change from when you did the video? Well, again, second screenshot would come from Bloomberg. And what the professionals would do is they'd go to DES, and Bloomberg summarizes for them the current shares outstanding right here on this screen. It's called the description. And right here is the current share count, 1.242.4 million shares. So 1242.4. So we'll come here and we'll type in 1242.4. And that is this screenshot here, which I've taken for you. And again, you're going to need to use these screenshots for your next assignment as well as for your group project. So I'm just showing you where you're going to get the data to update your company. That's a screenshot. And by the way, that would be the price today. I mean, closing price today. Now, the third thing we have to do is come down here and we need to put in a current price. And again, if I looked at Nike, today they closed at 79.23. So it would update the price to 79.23. And then finally, I want to update the new analyst estimates for revenue and EBITDA for Nike based on the current situation. This is where they were probably November 2019. Where are they April 2020? Well, that's going to be on a screen called the earnings estimate overview. So this is the consensus estimates that Wall Street has for Nike today, which again, screenshot, EEO. That's this screen, right? And so on this screen, what I need to do is I need to take the revenue for the next 3 years and the EBITDA for the next 3 years and put them into my model, right? So revenue at the time for 2020 was 42 billion, but now it's a little bit lower. Revenue is 39,276 this year. Remember, they closed a bunch of Nike stores. For 2021, revenue is now 42,534. For 2022, revenue is expected to be 47,097. So you can clearly see the effect of the recession, depression, whatever you want to call, on Nike, because the revenue forecasts have come down dramatically, even for this year, since November. EBITDA, 5073, came down by $1 billion. 5875. And 711. So you can see the EBIT margins have been coming down. And in terms of the multiples today, Nike is trading second forward year, 1, 2, EV to sales of 2.98, and EV to EBIT second forward year of 21.99, suggesting that the EBIT margin will be 13.6%. So when we go to the ratios, what I want to do is make sure that, first of all, the EBIT margin, EBITDAs have already been updated for these 3 years, but this margin here, instead of 13.8, because the trading ratios today, we back solve for it, it should be 13.6. So one of the things I'm going to do is change this to 15.4. Right? Obviously, that changes the share price a little bit. Next, I have to see if the tax rate is still reasonable. I still think it's going to be about a 16% tax rate. So one of the things that we would do is the analysts, these are the analysts, that are covering Nike, right, which have the buy-sell hold opinions, are on a conference call every quarter with the company, and this is where we can get a copy of the transcript of the call, probably get on their investor relations website. But if we were to search through the transcript of the last call, there's probably a mention of the tax rate, because the analysts are trying to do what we're doing, and they're trying to figure out the tax rate too in their model. So if I do a search for tax rate, they basically said tax rate this quarter was lower than 14.7 last year, do a shift, yada, yada. And basically we think it's going to be similar going forward. So the other thing I might do for you is pull up an analyst report, because the analysts are trying to do the same thing. So if I pulled up an analyst report, and one of the reports I'll use is JP Morgan, because I know they put the tax rate in their annual report. Then if I pulled up a JP Morgan analyst report on Nike, then here for their clients, they've taken what the company said, and most analysts are going to be pretty close to this, and they forecasted a tax rate where's the tax rate? Here it is, for the next couple years. So they say it was 16.1 down to 10.1, then 15. So 10.1 in 2020. And then back to 15. Okay, and obviously that will change the share price. So reasonable tax rate, not too different. Then productivity. This came from the tree. That's the invested capital to sales ratio. So historically, their invested capital as a percentage of sales has been 27, 25, 27, 29, 27. Right now, based on these balance sheet ratios, it's 25 cents per dollar of revenue. So what it tells me is I probably don't need to change these balance sheet ratios, because they're have about the level of productivity they have now, and it's been in the range they've had historically. Most big companies, unless there's a substantial change in their business, those productivity ratios don't change too much. You saw that in the analysis that you did in the big cyclical companies. So not going to change the balance sheet, right? So what I'm left with is I have a reasonable idea of the margin for 3 years of perpetuity. I have a reasonable tax rate. I got a reasonable balance sheet. Now I'm left with my growth. So what's my growth and what's my G? All right. Now I'll go a step further, and I'll say if I went to Bloomberg on the screen and looked at what the analysts are doing, even in the next years out, growth rate for 3 years. Whoever's on talking, can you put yourself on mute? Sorry, can somebody mute themselves? Becomes 10, stays 10, and then goes down to 5, 5.6, 5.9. So 2024, call it 6, 5.9. Growth rate. leave it around 6. But even so, that doesn't give me a share price model share price of 56, doesn't give me to 79. So obviously the market expects growth to be longer, higher term in perpetuity. Somebody asked about that, kind of backs off for that, 3%. So this is our final variable. It's probably going to be closer to 5. 5%, model share price 70, current share price 79. So I'm going to make this, I don't know, probably more like 5.3. 5.5. This will be slightly different than what I did in the last class because I lowered the growth a little bit more. But the whole point is I need to get to 79. So 5.7. Probably close though. Ratios. There we go. So now I'm within $1 and I'm close to the as is. So again, I can't say with 100% certainty that this is what the market's saying, but generally I think I'm in the ballpark that at this tax rate and this margin, at this level of growth and the similar productivity of the balance sheet, I explained Nike's share price today. Somewhere in here is a representation that I've backed into of what these analysts have done in their spreadsheets that they have locked because we have to pay for this research. But basically, when they are forecasting Nike just like we are, I can basically back in approximately what they must be using to get that share price because these cash flows justify the price. Working backwards with the formulas, I have a general idea what's going on with Nike. That is what we're calling the as-is valuation. I'm going to stop, pause, because I've been talking for a while, see if that makes sense. And that's how we would kind of update it to get more current. Questions? Comments? Remember, when you do the as-is, go ahead.
Sorry, one question. So one question regarding your, I think the growth rates for revenue. So you updated the 2024 growth rate, but if looking at the screenshots you have, looks like you also have values for 2023, 2022. Is it worth also updating those forecasted growth rates? Because we generally expect, and the way the formulas are laid out, that they're the previous year growth rates. But since they vary in the analyst reports, should we also factor that in?
Potentially, but here's the point. Assuming that we're using consensus, for the first 3 years, the growth rates and the margins, which I've highlighted, are actually being driven by the consensus estimates. So these numbers drive these 3 years. So we care more about is what's reasonable here. Okay. So again, here, this is why ideally you do an EIC. Okay. Because in your EIC, you would have talked about what's the industry like in 5 years and what's the competitive position in Nike in 5 years. And part of that should technically be kind of growth rate might this industry be growing at and what's Nike's market share look like in that? How fast are they going to be growing? So essentially, we would do the EIC to help us do this. Now, I'm kind of doing this on the fly, kind of making up some numbers. But what I'm saying is, kind of working through the share price, Nike's growth eventually got to slow, law of large numbers. Whether it's 6% or 8%, to be honest with you, that's not going to make as much difference. But the key is they're going to have to grow around 5.5, 5.7 long term in G to justify the current share price, given these margins and the jump in the higher cost of capital. Okay. Because versus where they were. And so there's some permutations here that say your numbers could be slightly different, but they shouldn't be that much different if you were doing this yourself and I wasn't around, right? But part of what you're going to do next week is I'm going to say there's a write-up in the next assignment. And this is also true for your group projects. And what I mean by write-up is you have to explain your rationale for why you put the numbers in you did. So if you came up with a different growth rate in these out years, you'd have to say, I use these numbers for this reason. And I use those numbers for this reason. So that's what I mean by the write-up. And that's what I'm going to be looking for, which is what is your sense of the numbers. But the as is less about your opinion, and it's a little bit more of a technical exercise. Other questions? All right, so from here, we're going to create 3 more spreadsheets. They're going to be called the bull, the bear, and the target. Okay, so what most analysts do, I'll go back to the JP Morgan analyst as an example. I think it was here. The JP Morgan report is, in a traditional analyst report, they'll forecast the share price. And what a lot of them will do is they'll have a graph of the future share price. They'll say, here's the best case scenario, here's the worst case scenario, and here's where I think the share price will be. And oh, by the way, this is the risks of what could change in my model that could lead me to go to the bull and the bear. Could have problems with price, could have some additional competition, could have some supply issues, could have some currency and tariff issues. So those are the things that could cause me to be wrong in my assumptions. So here's the point. What's useful for an investor is, don't just tell me what you think Nike's worth. Tell me how good it could be, and tell me how bad it could be in the next 12 months. I want to get a sense of my risk, which is tell me the range. And that's the idea of the bull and the bear. So back to bull and the bear. What we're going to do is we're going to take our as is, we're going to save it. File, save as, and then we're going to name it the bull. Now we're going to put on our rose-colored glasses. So somebody tell me a story of coming out of this great recession. What could cause Nike to do even better in the future than what do you think the market's expecting? What are some of the things that could really benefit them?
Competitors don't make it.
I agree. So this is going to shake out a lot of the smaller competitors. Strong survive, very Darwinian. How do you think that will translate financially? Do you think they're going to have more growth because the competitors don't make it?
I think they'll have revenue growth.
And here's the reason, is because if there's less competitors, they're going to get a bigger share of that pie. So instead of growing at 10%, I think they'll grow at 12. Instead of growing at 6, I think they're going to grow at 9. And then I think they're going to grow at 8 or 9. By the way, I also think their margins, instead of going to 15.4, are going to go closer to 16 because there's a lot less competition. I think it's going to happen sooner. So instead of 14.9, I think it's going to be 15.5, and I think eventually it's going to be 16. I don't think the tax rate's going to change, but I also think that long term, instead of growing at 5.7, maybe they start growing at 6.5. Oh, by the way, $102 share price. I'm not saying it's going to happen, but what I'm saying is, I think if all of the things that she just described happen, that could be a reasonable share price for Nike if everything goes well. And by the way, in the real world, the target share price is, there's a guy who thinks Nike should be at 125. So as positive as I was, he thinks it's going to be even better than that. I'm not saying I agree with him, but I'm saying that's the idea of the bull. Now we got to be, I don't want crazy town here. I want you to start, making something up that's so far afield that you just create some weird share price. But that's the point. When I say write up, I want 2 things. I want specific numbers that you're changing and why you're changing them, and then the context, as she just brought out, that would lead to me to believe why those numbers could go up. This is also why it's important to kind of do an EIC, ideally for your group project, but at least do a little riffing here, some context for the bull. So that's my bull. Everything goes well, that's my bull. All right, so I've saved that. Got a high now. Valkyrie, well into the buy territory. So now I'm going to go back to my original as is, and I'm going to save this one. And now I'm going to do the bear. All right now, I'm just, sky's gloomy, world's going to come to an end. I'm putting out my bear. Bears are growling. What's going to cause the bad scenario, which says it's going to be much worse than this for Nike long term? What would that be? And how would we translate it into changes here in the model? What's a realistic bear scenario? What do you think?
The world went into a pretty big recession after this, and they can't recover because nobody's buying what is essentially a luxury item of $100 shoes.
Yeah, and we get used to not buying them and buying a lot of cheap brands, so maybe the brands lose their cachet. Okay, so what do we change?
So their growth goes way down.
So maybe we're at 4 to 5% a year instead of 10%. And oh, by the way, maybe the margins don't recover to 15.4. Maybe they stay recessionary level closer to the 13s. Now we're at a $63 stock price, which says Nike's got a lot further to fall. All right. So essentially, I got my bull, my bear, I got my range. And more importantly, I had the Y of the range. What would cause it to be near the top? What would cause it to be near the bottom? That's the bull and the bear. And I specifically supported that with the numbers in the model.
Question.
Yes.
What if, let's say, the Democrat wins the elections and for the next 4 or 5 years, they change the tax rate?
Back to what?
Let's say 21%.
Well, right now it's 21%. And
Okay.
Nike's paying 15 on a 21% tax rate. So you're using some good tax people to move money. But let's say it goes back to 35.
Yes.
When it was 35, they were paying in the 20s. So Democrats win, change tax law. This goes to 20, 22, which still get some tax breaks. There you go. That's your scenario. And again, I can't say that that's an incorrect scenario because if the Democrats really take over, they're talking about raising taxes. And they're talking about repealing the corporate tax breaks. So that could easily be a bear scenario. That's very believable. Okay, not saying it's going to happen. So the point of the bull and the bear isn't that it will happen. It just has to be a realistic probability that it could happen. And you're giving a realistic bad scenario. And that's a realistic bad scenario. So that's part of my bear, which says, okay, if I'm really thinking about Nike and these bad things happen, the share price can get down to 57. If I think about Nike, these good things happen, share price can get to 125. So the final question, all right, what do I actually think? Where in that continuum is Nike going to be? That's the target. And that is model number 4. So model number 4 is now my opinion. I've set a high, I've set a low, and the target, if you haven't figured this out, needs to be somewhere between the two. So where do they end up? What do you think? Because if they end up where they are now, it's a hold. If they're more than 10%, towards the 125, they might be the buy. Towards the 50 something, they're going to be the sell. So what do you actually think? Anybody?
I mean, if you're a long-term investor, I would say you can hold.
So you think that they're fairly priced?
Yeah.
Okay. So forget the long-term investor point. If you say they're hold, then you're telling me that around $79 is a fair price and that this should be the ratios that you expect.
I mean, I may be wrong, but I think the way the market is priced now, if you're looking at just, I don't think it's mostly about fundamentals. It's also about, fears and, other things. But if you're just looking at the business itself, I think those ratios are reasonable, and I would hold.
But that's the point. I'm asking you the second part of your question, which is, are these ratios reasonable? So if the answer that you think these ratios are reasonable, then you agree that the hold is warranted. Does everybody have that opinion? Are these ratios, as we see now, the ones that are most likely? Or do you think that it will be more different? And again, there's no right answer here. That's the beauty. I mean, even on Wall Street today, you don't have unanimity about what's going to happen to Nike. Now there's 28 people who think Nike is undervalued. 6 of the analysts agree with who just made the comment, and 2 really hate Nike, say it's going to be worse. But even in Wall Street, there's a range. So,
and I could see why some people would think it's undervalued, and I would think they're not just looking at it for what it is today. But I know you said I shouldn't look into the future, but they're looking it down the road, saying that Nike continues to innovate. It has a good branding power. They sell good shoes. They're marketable. So if I'm looking at the sum total and just ignoring the glitches in the economy in the short term, I would say it's undervalued. But if I'm looking at today, based on those ratios, knowing that sales might not, be what it's supposed to be, and all the other stuff, I think that it's a fair value.
So here's the point. The ratios that support today, you're looking at on the screen. And if your point to me as an investor is you think long-term, the ratios will be better long-term, and that's a buy, then that's a different model in your target. There's a difference between the as-is and the target. And the target is your opinion. The as-is is not your opinion. The as-is is much more objective. So that's the point. You're arguing both sides. You're saying objectively, this is what the market says. Exactly. That's what we did. But do you have to agree with that long-term? No. If you disagree with that long-term and you put your values, you could support that. You could support a thesis that they're undervalued, which was the bull, and that leads you to a higher share price, and that leads to a buy. So buy Nike, because longer term, you're going to make money.
Okay, I get your point.
But I'm saying that's what I'm going to need you guys to do next week.
Yeah.
So when I say next week's assignment, you're going to turn in 4 Excel files, and your group project, you're going to have 4 Excel files. These are the 4 files. And when I say write up 500 words about your assumptions as you change from model to model, this is what I'm talking about. You have to link, all right, why did I change revenue growth to what I did? What's my context? In the context of the bull, why did I change it to what? Why did I change the margin? Why did I change the tax rate? Why did I change the G? Did I leave it alone? If I left it alone, why did I leave it alone? How did that translate to a share price? You're going to repeat that process 4 times, right? You're going to always do that, including for your group projects, because that's the process I want you to think about. And oh, by the way, be consistent so that when you do your group project in 3 weeks, and somebody in the EIC says, oh yeah, this industry sucks, the power of the buyer is really bad, and there's no, all suppliers have lowered over us, and there's no barriers to entry and tremendous rivalry in this industry. And then somebody in the valuation's like, oh, this is a buy. It's such a great industry with no competition, and look at all these margins. Then you're going to hear me chuckling, right? Because that's the entertainment value I get as I lower your grade. Because basically, you need to make sure that you're consistent. So that's the whole point. Like if you say the industry sucks, then your valuation model should represent that, right? If you say it's a terrific industry, then your valuation model should represent that. There should be consistency between the two. I know we didn't really do that for Nike. We didn't do the EIC on Nike, but that's the idea here of helping you support the story of your numbers. And again, I can't tell you you're wrong in the future, but I'm going to grade you on, are you using the data and are you making reasonable assumptions? Follow the process. So questions about what we just did? And again, we just updated Nike through today using the model.
Yeah, I have a question. So if you were to, I guess, project that the weighted average cost of capital were to be reduced in the future, what kind of justification would you expect behind that?
Well, that one's tougher.
Yeah.
And the reason why is if you read through the book, one of the comments was in an enterprise DCF, we generally use a target capital structure, which doesn't change for the valuation. And assuming a target capital structure, you keep the WACC constant in your model. Because there's two ways to do a valuation. I can change the WACC or I can change the cash flow. And McKinsey's approach is, and this is more emergent in finance, is basically the WACC is the WACC. Like the long-term risk of the business shouldn't change year by year. And by the way, if it did, it'd be too damn hard to figure out anyways. So basically, there's like the inherent risk of the business, which should be similar long-term. And then the real difference is how the cash flows adjust. Now, you could make an argument, and this is true, that every now and then you're going to see in the real world a crazy WACC. And I'll give you an example because they asked about this in the last class. So if I were to go to Ford right now, and I were to look at Ford's WACC, today, Ford's WACC is 2.6%. The long-term return you get owning Ford is 2.6%. And given the fact that Ford's on the verge of bankruptcy, that seems pretty low. Like for the level of risk I take in owning Ford, I'd want to make more than 2.6%. Right? Now, why is Ford's WACC 2.6%? It's actually because they're on the verge of bankruptcy. Because they're 81% debt in today's low interest rate environment, it makes their WACC artificially low. So here's the point. If I were to do a peer analysis, what I might do as an analyst is I might look at, show me the industry WACC. And the industry WACC for auto right now is closer to 8.5%. So even though Bloomberg is calculating a low WACC for them today, this just seems low for the type of industry that they're in. So I might use the industry WACC represented in my model than the other WACC. Give you an example, if I flip this to Nike, you might say, well, gee, Nike's WACC seems pretty high versus where they were in November. Is that too high? Well, if I look at all the apparel companies, they're all in this range. Why do you think the apparel companies are on there? I challenge you, well, don't do this, but you can't go to a Nike store to buy anything because first of all, you're going to get arrested or ticketed if you leave most of our cities in this country, like Maryland is shut down. And secondly, where are you going to go? Because all the stores are closed. And Nike's not selling it to anybody. Maybe Amazon, but there's the point. There's a whole lot more risk to these apparel companies because you can't buy any of this. So yes, the WACCs are up. And yes, I could understand why the WACCs are up if I'm going to go invest in these companies. Because there's just so much uncertainty with what's happening in the apparel business. So again, we have to kind of apply a reasonableness test to these numbers. It's easy, and I tell my undergrads this, to plug and chug, because they're plug and chuggers. But at the end of the day, you got to be thinking about what you're plugging in. And sometimes you're going to plug in stuff that's not going to make any sense to you. And you got to take a step back and say, okay, I know this is the number I'm looking for, but this number doesn't make any sense. And then I might have to actually use some judgment about what's reasonable. Good question. Other questions? Okay, so here's what I want to do. We're going to then practice doing another company. And what we're going to do is Walmart. Okay, because again, this is part of what you're going to have to do for next week's assignment. So how do I use this Nike model we just did and update it for Walmart? So I'm going to do the one that you turned in for your homework assignment. Nike. Yeah. All right. So this is the one that you would have done for your homework assignment. And what we're going to do is we're going to use this file to update to do a Walmart valuation. So the first thing I'm going to do is save this as the Walmart as is. And this is for the 845 section. All right. So to update the model, which is what you're going to have to do for your group projects as well, is the first tab is the historical financial statements, income statements, and balance sheets for Nike. So what I'm going to do is I'm going to give you a file from Bloomberg, which basically has it's called WMT data. And by the way, if you're playing along at home, in the Walmart folder for week 4 are these files. Okay. So here's the Walmart data file, and then 3 screenshots from Bloomberg today. So for Walmart data, what I'm going to do, I'm going to give you that file. You'll open it. You'll then take this tab, historical data, you'll copy it. You'll select the entire tab in the valuation model. You'll right click, paste special values. And so you'll overwrite all of the Nike data with whatever the new company is. In this case, it's Walmart, sell for sell. And so now the model is ready to do Walmart. But we still have to adjust some of these ratios and assumptions. So let's make sure the assumptions are ready. Last reported year. Well, for Walmart, they've actually reported fiscal 2020 because retailers consider January 31st the end of their fiscal year as opposed to December 31st. So Walmart's actually in 2021 as far as they're concerned. So 2020 has already happened. So in the assumptions, 2020. Now the model will automatically adjust the relative years based on that, but we put in 2020. Operating cash, we're generally going to leave alone, but in Walmart's case, if we go to TFI, we will notice that historically, Walmart had negative excess cash because 2% of sales says everybody needs at least 1 week of cash to operate. But believe it or not, if you look at Walmart's balance sheet, they operate, I'll unhide these cells. Where's hide? Unhide. They actually operate on less than a week of cash. They have negative excess cash relative to their operating cash because the two together is their cash balance. So for Walmart, I'm going to say their operating cash is 1%. And that is going to turn their excess cash positive historically. Just moves around operating in excess. Something that you're rarely going to have to do. Walmart just likes to cut it close because they're Walmart and they know they can get the money if they need it. Assumptions, WACC. What's Walmart's WACC? Well, today, again, I go and I look at my screenshot. Today, Walmart's WACC is 4.7%. So in this low interest rate environment, 4.7%. G will come back to shares outstanding in the description file. We'll look shares out for Walmart 2832.3. 2832.3. Their current share price, they closed today at 115.17, call it. So actually, where'd they close today? Let me double check. I'll use this, 115.17. We'll use that number, 115.17. And then we need to do their consensus estimates for revenue, EBITDA, and multiples. So we would go to the EEO, the earnings estimates, and we'd see what their revenue estimates were for the next 3 years. 539 billion, 539,786. Then for 2022, their revenue would be 554,882. And then 572,190. Their EBITDA for 2021 would be 33,488. For 2022, it would be 34,402. And for 2023, it would be 35,604. Their second forward year, count 1, 2, EV to EBIT, 0.71. EV to sales, 0.71, EV to revenue. And EV to EBIT for second forward year, 1.2, 17.15. So we know that their long-term margin should be 4.1%. So I come over here to the ratios. Is the tax rate for Walmart reasonable? Right? Now remember, right now, these are not Walmart's tax rates. These are Nike's tax rates. So I got to make sure I have Walmart's tax rates in here. Well, if I actually look at the analyst, which I did earlier today, Walmart's tax rates are expected to be about the same. So I'll just, for interest of time, I looked it up. I'll give you the data. But generally, if you go to the analyst report like we did, then the analyst reports will say it's around 24%. So we're going to leave 24 in. Right? Next, for the EBITDA margin for the first 3 years, 6.1. For operating income in the first year of perpetuity, we have 4. And the model says we should be at 4.1. So what I'm going to do is I'm going to come here to ratios. Let me get that to 4.1. I'm going to make that 6.2. Right? Now for the growth rate, or sorry, for the productivity, Walmart's at 28% of invested capital sales into the future. Does 28% look reasonable? As a balance sheet productivity into the future? Does 28% of revenue look reasonable? I think it does. Because they've been at 28 a couple times. Now it's probably at the high end of the range, but it's probably close to the range. I probably can leave our balance sheet ratios about the same. The way I think I mistyped here. This is supposed to be 4.1. So this should be 6.3. Nope, 6.2. Had the Nike number in there. That's 4.1. All right. So finally, I need to basically think about my sales, revenue growth, and G. Well, even if I looked at the out years of the growth rate, Walmart's probably not going to keep growing at 5 or 6%. It's probably more like 2 or 3. And again, I got to match these share prices anyways. I'm at $2.50 a share. They can't possibly grow this fast. All right. So I'm going to put 1%. Right. Whether it's 1 or 2, it's not going to change the price that much. So what this tells me is my G is too high. So G can't be 3%. What if my G were 1%? Now I'm going to share price within a few dollars. I'm $9 away. What if my G were 0.5%? Now I am very close. I'm in my dollar. This is the as-is process. This is the process that you would have to do to update your model. This is the process I want you to work through getting to sales last. Matching within $1 the share price. Questions about what I just did? And by the way, if I left this at 6.1 instead of 6.2, I'm even closer. Questions about any of this? Can you repeat this process?
So this is Walmart as is.
This is Walmart as is, April 1st, 2020.
Okay, thank you.
So I've shown you 2 things tonight. Number 1, what I've shown you is how we took Nike, your homework assignment, and we updated it through today. And what's the process to make some changes to the as is to do that? I then showed you how we can create 3 scenarios: a bull, a bear, and a target, which is somewhere between the bull and the bear, which is our opinion. We repeated part of the process with Walmart where I said, okay, we could use this as a reusable model. That was the whole point of why we did what we did. And we basically replaced Nike's data and overwrote Walmart's data. We updated using current information, assumptions, and ratios, and we did an as-is based on the share price within $1. From here, bull, bear, target, right up. I'm not going to do that process here, but that's basically what your next assignment's going to be, and also what your group project's going to be. Because very shortly, just as I put into here, I put these 4 files for Walmart, I'm going to put these 4 files for each of your teams. So you'll have the historical data for the companies that you're working on, you'll have the earnings estimates, and you'll have the WACC. Okay? And just like we did, next week you'll practice individually, but then you can quickly start working on your teams, because that's the valuation. Those are the 4 models you're going to have to do for your teams. And you now have a final valuation model to do that. Right? Questions? Comments? Hopefully it makes sense. All right.
So
Well,
just a random thought or question for you. So if someone is making any assumptions without having real-time data, like you're having from this Bloomberg terminal, are they doing themselves any disservice?
well, I mean, the problem is you're guessing. Now we're still guessing, but what I'm actually doing with this guessing is I am guessing with the pros. So I at least can see the guesses they're making, and the guesses they're making are used in the community of the people that are actually buying and selling. Okay. So I'll give you another example. Here's something that's very important to hospitals right now. Does everybody know what an N95 mask is?
I use them every day for the
They're
last
very
3 weeks.
critical given what's happening today. So how much do they cost to buy wholesale today?
The price probably went up maybe like 100%.
So what's the price?
I don't know.
There's the problem. That's the same thing we're saying, is that somebody, if you're forecasting sales for N95 masks, has to figure out what the price is, and they have to figure out the volume of sales is. And I understand that we know it's going to be higher, but there's going to be 2 people. There's going to be me, who actually has been following the secondary market for N95 masks, and I actually know what deals are being closed at today. I'm going to put in a guess. And there's you, who uses them every day, and they know they're higher, but you don't really know how much. That's the difference of what we're doing here today. Okay. And by the way, the answer is somewhere between $6 and $6.50 per mask. They were 85 cents a month ago. And that's at scale. If you want to buy like 20 million of them, if you could even get them, supply and demand. But that's a separate story. But the point of the story I wanted to make is this is one of the advantage of kind of using a software tool like Bloomberg. And unfortunately, it's sad that even if you wanted to, you couldn't go to Van Munching Hall because the building's closed down. But this is one of the disadvantages a lot of people have, is because they don't have access to the actual guesses of Wall Street. That's one of the reasons why Bloomberg software is so expensive, because you pay a lot of money to get access to people's guesses. And it's not saying that people are right or wrong. But remember, I said this is the first week of class, price is based on expectations. So if you don't know what the expectations are, you have no idea why the price is what it is. So what I'm trying to give you some insight to is taking some proxy advantage, is I'm showing you what the expectations are. And therefore, the price and you know why the price is what it is. That's the whole point of the as-is model. And what you're going to at least practice is using some of this data to start coming up with more realistic forecasts, right? But after this class, without access to this, it gets harder because you really are guessing the future if you have no idea. Like what I feel sorry for is the people that are trying to do Nike out of Yahoo Finance. Because all they're looking at when they look up Nike, NKE, is they can look at historical data and they can look at historical financials. But that's the point. If I look at Nike's historical financials, how do I know what the growth rate's going to be in 21, 22, 23, 24? I'm literally throwing darts at a board. I have no idea. I can try and look at what it was historically and use that as a proxy, but as you can see, based on what we did tonight, it's going to be hard to guess. I'm not saying Wall Street's right, but at least having access to their guesses is useful, right? But regardless, that's what we need to do is we need to make some guesses. And that's the process, or that's the art of valuation. Other questions, comments about any of this?
So my last question, which I think I already know the answer, is so in a nutshell, understanding you know, an industry spread and looking for the best companies in the industry, you would say is the best way to invest, right?
Well, you're assuming that the current situation repeats itself. If the current situation doesn't repeat itself, not necessarily, right? So, that's the problem. So let's be more specific.
Okay.
But let's take an airline. Let's take Delta Airlines as an example, right? Here's the problem with Delta Airlines. This is Delta Airlines revenue forecast for 2020. This is what they did last year. Delta's revenue is going to go down by 30% because of the crisis, according to Wall Street. And by the way, it might even go down more because they're not flying many jets, and the jets that they're flying have nobody on them. And I don't know how long this crisis is going to last, but it seems like it's getting longer, not shorter. So this number might be optimistic. So that's the point. We're making a guess about how bad this is going to be. And then the question is, does it recover? And if it recovers, how much does it recover? I think it's an open question to say, are Delta's volumes next year going to be the same as last year in a post-virus world? We just don't know. Wall Street doesn't know. Yet those are the guesses that we have to make. So that's the problem, is that even if we use historical data, we can't use the historical data for the future because the future could be different than the past. So the trend line here is going to be crazy because nobody knows what the trend line that got us here is going to be. Couldn't have predicted that. And then going forward, the analysts are probably all over the place because there's a lot of scenarios for bear scenarios which say it takes a long time to get people to trust to get on planes again. Or maybe there's just pent up demand and they can't wait, they're going to be jammed. I don't know what's going to happen in 3 months because I can't even tell you where I'm going to be allowed to travel again because every corporate client I work with is locked down. When's that going to happen? And if I want to travel somewhere, the country's going to allow me to. So those are the questions which would eventually be into this revenue forecast that everybody has to solve. There's a lot of uncertainty here. So Walmart's an actually easier company because people are still going there the same amount they were going, before the crisis. Say they were Costco. Airlines, different story. So the trend is just different. Or if you did a startup, like I feel sorry for this group. This is Peloton. One of the teams, I think at the last section, chose Peloton as their group project. Look at this. For the next 3 years, Peloton loses money. Actually, next 4 years. Peloton has never made money. Peloton's not even expected to make money. Yet they got a share price of $28. Put that in our model. right? You did an assignment in week 2 where you said if you grow a company that has a negative spread, you can't get a positive value. Well, that's basically what Peloton is. So they had to come up with a forecast in years 5, 6 in perpetuity that says the company's eventually going to make money at scale. And that's 5 years out, and they haven't done it to try and figure out how you even justify this price and whether or not it's right. So that's actually going to be a very challenging project. Looking forward to hearing what they say. In fact, they don't even have multiples because they have a price to earnings multiple. You need earnings. They don't have earnings. To have an EV to EBIT, you need EBIT. There's no EBIT. So I told them they might want to consider changing, see if they do. But regardless, somebody's got to still price them. So we still have to figure out the values in years 4, 5, and 6 that lead to a positive share price. Otherwise, why would you pay $28 for Peloton, given these numbers? You wouldn't do it. They would be a more challenging company than Walmart to value. All right, so we've accomplished what we did in the other class. So what I'm going to do is we're going to give everybody a few minutes back of your lives tonight. So just to give a sense of this, you can see the files up here for Walmart and Nike. We're going to basically put in your team projects. I'll give you similar data so you can do it for your teams. And for week 5's assignment, you're going to go through a process similar to what we did tonight. I'll post the data for another company. And you're going to have to write up, as you walk through the assumptions, the bull, the bear, the target, and the as is. What's the revenue? Why'd you change it? What's the growth rate? What's the EBITDA margin? Why'd you change it? What's the tax rate if you changed it? What is the G if you changed it? You know, I don't think you should be changing the WACC, but if you did want to change the WACC, why'd you change the WACC? Although I wouldn't recommend changing the WACC. Basically, you're going to talk about that for each of the scenarios. That's what we mean by the write-up. Make sure you use numbers and references to the data as you go through. Okay. This will be recorded, or was recorded, be posted on YouTube in a minute. There was also very similar, if you want to see another version of this for the 7 o'clock class on YouTube, it's already there. And we'll see everybody next Wednesday. Hopefully the Zoom will be able to work on the Maryland Zoom, and we'll be able to use that one. Okay. All right. Well, again, I'm going to stop the recording. I will post, and thank you for what you did. Have a good week.